Hey investors, not all companies are what they seem. Even profitable-looking businesses can hide red flags in their financial statements. In today's video, I'll show you the top 5 red flags to watch out for before you make an investment. Red flag number 1, declining margins. If a company's gross margin or operating margin is shrinking over time, it could signal trouble. A healthy business should maintain or improve margins, not see them dwindle year after year. Let's take an example. Suppose a company's gross margin went from 40% to 30% over 3 years. This could mean increased competition or rising costs that they can't pass on to customers, potentially leading to long-term profitability issues. Red flag number 2, high debt levels. A company that relies too much on debt can be risky, especially if interest rates rise or cash flow falls short. Look out for a high debt-to-equity ratio, which indicates how much debt a company is using compared to its equity. Here's a quick comparison. A company with a debt-to-equity ratio of 2, one is riskier than one with a ratio of 0.51. It means they owe $2 for every dollar of equity, making it harder to survive economic downturns or rising interest rates. Red flag number 3 is poor cash flow. A company might show profits on paper but still struggle to generate positive cash flow. Watch out for companies that consistently report negative cash flows from operations, as it suggests they are struggling to manage their day-to-day expenses. Consider a company with negative cash flow for 3 consecutive years. Even if they report net income, it could mean they're relying too much on debt or external funding to keep the business running. Not a good sign for long-term sustainability. Red flag number 4, aggressive accounting practices. When companies try to inflate their revenue or reduce expenses with questionable accounting tricks, it's a serious warning. Look for unusual revenue recognition, large one-time gains, or frequent changes in accounting policies. For example, if a company books revenue before actually delivering a product or service, it can make their earnings look better in the short term, but it's not sustainable. This can lead to a revenue restatement down the line and major stock price drops. Red flag number 5, frequent restructuring charges. While a one-time restructuring might be necessary for a company's survival, repeated restructuring expenses could be a way to mask ongoing operational problems. It might suggest that a company is constantly trying to fix underlying issues without success. Let's say a company has restructuring charges every year for the past 5 years. This could mean they're struggling to adapt to the market or are trying to adjust their business model without real success. It's a major red flag for potential investors. So those are the top 5 red flags to look out for in financial statements. Spotting these early can help you avoid bad investments and protect your portfolio. If you found this video helpful, make sure to hit the subscribe button and turn on notifications to stay updated with more tips on becoming a smarter investor. Drop a comment if you have any questions or suggestions for future videos. Thanks for watching, and I'll see you in the next one.